So this is something that gets brought up by a lot of people, and they ask in the comments all the time, how many stocks or investments do you need? Or people might ask something like, this is my portfolio, it's got these 6 funds in it, is it a good idea? And most of the time I'll write something like, looks fine, just stick with it for a long time, there's no way to know if this will end up beating the market, just do what works for you. And as fine as that comment might be, there is a lot more in the detail that I think people might be getting wrong. By the end of the video, I think you'll be in a much better place to understand whether or not you might have too many or too few investments in your portfolio. Let's get to work. So if we just wipe the slate clean for a second and pretend we're starting from scratch, our goal as an investor, for most of us at least, is to make as much money as possible. And if we knew the future and we could zip forward a couple of decades, there will be one stock or that one thing that beats everything else. It could be a stock that exists already like Nvidia or Tesla. It could be a small company not even on our radar yet. Or it could even be something like Bitcoin, as much as you might either love it or hate it. Now, because we don't know the future and we don't want to take too much risk, investing is all about balancing that risk with making sure that we get good returns. Now, everyone will have a different level of what risk they want to take. Some people are happier taking more and others are happier taking less. Most of us will probably fall somewhere in the middle, and we know that investing does have risks, but also, if we're sensible about it, the rewards can be well worth it, as long as we think about it for the long term. So the obvious solution to this problem is that we diversify what we invest in. And to do this, we own lots of different stocks. Some of you might even choose to invest in an index fund, like a fund that invests in the S&P 500. Or closer to home here in the UK, some of you might love the FTSE 100 so much that you choose a simple index fund to cover that one as well. I mean, someone has to love it after all. Or another option that I see a lot of people doing is you own a global index fund, and then on top of that you own the S&P 500, the FTSE 100, and then maybe even some dividend ETFs. So here's where things get interesting, and I'm going to try and explain it using the example of food, but wish me luck. So imagine a basic pasta dish. We've got onions and garlic for the base, chopped tomatoes, some nice pasta, and then we can sprinkle on some Parmesan cheese on top, and maybe even, to top it off, a little bit of basil there as well. Quick, easy to make nice dish, nice and simple. Now, imagine that this is what your investing portfolio should look like. Everything's in the right order, the proportions are good, and you're nice and full afterwards. Let's just say that this dish is like the base of your investments. Maybe it's a global index fund or even an S&P 500 index fund. All of the stocks or ingredients inside it are all based on their size or weight, and you just let the market decide what those weights are. If you want to make the example even more interesting, you could say that Microsoft is the pasta, Apple is the tomatoes, and Nvidia is your garlic and onions. Now here's where things get interesting, and I think where a lot of people might get a bit mixed up with their investing. So we just said that this dish is everything we need, but when it comes to investing, we're always tempted to add more and more things in. And the big issue we have today is that those things are just different versions of the same ingredients, at least most of them, but let me explain again. So a very common question or comment that I get often is, my portfolio is half S&P 500 and half a global index fund, or something like that. Let's just break down the ingredients for a second and I'll show you what I mean, and that could potentially be a bit of an issue. So let me grab a global index fund, and if I put up on screen now what's inside of it, everything will start to make sense very quickly, or I hope it will anyway. Here's what the top 10 holdings are, but you can also call them ingredients if you really want to. Now, all of the biggest companies in the world are ranged by their size, and it's no surprise that it's all the US stocks really at the top. Now, these top 10 ingredients in this global fund come to 16.64% of the total dish. That means that for every £100 you have invested, £16.64 will be invested in these top 10 companies in that order. And the biggest share would go to Microsoft, which is currently the largest company in the world. And they'd get £3.77 because they make up 3.77%. Hopefully nice and simple and you're all following along. Microsoft is the big plate of pasta and everyone else just makes up the rest. Now, what about the S&P 500? Well, if I grab that index fund and see what its holdings are, or ingredients, got to keep this example going at all costs here guys, I'm doing my best. So here's what we'll see. It's pretty much exactly the same companies with a couple of slight differences. But the main difference is the weighting. So instead of the top 10 companies making up 16%, the S&P 500 actually has the top 10 making up 32.1%. So bring this back to the example for a second. It's the same ingredients, just in different proportions. Now, whether these proportions taste good or not, we might not know. But what we do know is that these proportions are not what we started out with at the beginning. And what starts to happen if you invest like this and start adding on different funds is that all you're doing is adding more of the same stuff in different amounts. Now, just think about this for a second. Over the long run, when you invest, some companies end up growing more than others. And these ingredients either move up or down the list as people decide what they like. I guess you could almost say that as people's eating habits change, then the market changes with them over the long term. However, if you start adding in too many funds together, which might have similar ingredients, you might end up missing out on making the best dish. For example, just because one fund has done really well for the last few years, doesn't mean that it will have the same performance moving forward. And also, if a fund is really concentrated on a few big companies because they've grown a lot recently, again, this doesn't mean that it will keep continuing to grow in the future. So what I'm trying to explain here, probably pretty badly at this point, is that anytime you add an investment into your portfolio, you're making an active choice that will change the balance of those stocks or ingredients. The only time it might make sense to add things to your portfolio would be if it wasn't already something inside, like bonds, gold, or even Bitcoin, I guess, won't be inside a global index fund. So if you added this, it might be like adding on a stick of garlic bread to go with your pasta dish. Let me also just give you another example that gets brought up as well quite a lot too. So one of the most popular indexes that people love because it's done so well is the Nasdaq 100. This is a list of the most popular technology related stocks, and its performance over the last 5 years has been amazing, with a 145% return compared to the S&P 500's 58% if you base it just on price alone. Now, inside the Nasdaq 100 is, guess what? Pretty much the same stocks or ingredients, but they're even more concentrated. It's all Microsoft, Apple, Nvidia, but then you get Broadcom, AMD, and Adobe instead of Amazon and Alphabet. Here's the key thing though, the top 10 stocks make up 36% of this index. So it's very concentrated, and if this was a pasta dish, it would reek of garlic. Not that that's always a bad thing because I do love garlic, but the point is that it's the same ingredients, just more concentrated, and this means that you might be putting your financial future at stake by going with fewer companies. Remember that all you care about now as an investor is what the performance is going to be in the future. You have to put the past behind you because that is not relevant to the money that you have today ready to invest. All of these are great companies, but that does not mean that their share price is going to go up over the next 10 or 20 years more than the share price of the average of the whole market. And that is where the global index fund comes back into things. Imagine that the global index fund is your nice and simple pasta dish. Everything is neatly arranged, and we said that the proportions are just right. With something like this, you get everything on one plate, all cooked for you, and over the years, it might even change slightly as people prefer more or less of the individual ingredients. The moment you start adding things on, like your garlic bread, is the moment that you start to become an active investor rather than a passive one. Now, this isn't a good or a bad thing as such, it's just worth being aware of because the majority of active investors out there who try and beat the market do fail in the long run. That is just a fact. It doesn't mean that they lose money or that their pasta dish tastes bad or that it can't do very well in certain periods of time. It's just that they might be missing out on a few little points of that over the long run do add up to be quite a lot. However, with that said, we are all human after all, and we like different things. So at the end of the day, we have to make a dish that is just right for you. The main point I wanted to highlight was that with investing, it's very easy to end up with a really complicated portfolio that you just add on different funds and stocks over the years. You can turn a really simple portfolio into a Frankenstein one, and I know that from personal experience, as this is exactly what my early years of investing looked like. It ended up as a mix of different funds and stocks with loads of the same ingredients, but all over the place. And this made managing it really hard because I didn't know how much of each one I should be investing in and where I should put new money in. And then I found myself questioning what I should have been doing and what I should do, rather than focus on the more important things like getting as much money in and being consistent for a really long time. That's the biggest danger, I'd say. It's not that you're going to lose all of your money if you have 4 different index funds. It's just that anytime you make something more complicated than it needs to be, you put up another barrier and risk making a bad decision, in my view, which in investing can cost you a huge amount of money, especially in the long run. From my own personal perspective, I try and follow a simple rule that says the majority of my investing should be low-cost global index funds. And I make sure that all of this is done inside of a stocks and shares ISA. As always, the platforms that I use, I keep in the links in the description. So if you do want to get yourself started, there's some good offers there available below. Check them out after the video. But on the side, I do allow myself to have some freedom and make some bets with a smaller part of my portfolio. As I know, if I didn't do this, I'd probably get bored and start making some bad decisions with my money. We are humans after all, and I know that personally, I can be quite impulsive and I can also be a little bit impatient. So this is my way of managing my small chimp brain. So is that the answer then? Keep it simple, don't invest in too many things and you'll probably be just fine? Probably something like that. The truth is we'll just never know unless we can fast forward in time to see what might truly be the best portfolio. I'd put a strong bet on that keeping your portfolio in low-cost index funds will still perform very well for many, many decades to come. But hey, that is just my view. Now, if you are looking for some ideas on what index funds to invest in, this video has been really popular, taking you through some of my best picks for the year, and I'll see you over there. And until next time, happy investing.